Hey, this is Alex from Voyage Financial, and what I'm going to be talking about today is how banks set interest rates. I've subtitled it The Shocking Truth because it's not really that shocking. You won't be surprised to learn that banks are not setting their interest rates to help you out, and in fact, they try and make it as confusing as they possibly can. So let's get stuck in. What we're going to be talking about today is what lenders actually need to do to attract new business. There's really only a few things they can do. I'm going to briefly talk about the RBA and the RBA's involvement with setting interest rates, the rate that you see and what actually affects that interest rate, what happens once you settle, what bank executives really think about you, acquisition versus actual rate, should you fix, and the approach that we at Voyage Financial take. So if you can't stick through the whole thing, or this is like the too long didn't read, firstly, don't get too obsessed about interest rates. Like interest rates that are 0.1 or 0.2% or even 0.3% better than what you've got, unless you've got a multi-million-dollar loan, really won't affect your long-term future or long-term financial outlook really much at all. And there's actually, I can show you the maths. I'll probably do it in a separate video. I won't do it in this one, but there's some pretty clear maths that shows that it's not, it really makes very little difference. Okay, so really number two, the rate that you get will rarely be the most competitive on the market. You'll notice if you've had an interest rate or home loan for more than a couple of years, there always seems to be a better interest rate available on the market. There's a reason for that. Number three, really what we are aiming for is the best rate that you can find online, plus usually 20 to 30 points. So if you can see an online lender or your lender come out with a better interest rate, as long as your interest rate is within 20 or 30 points, that's about as good as we're going to get over the long term. And refinancing to always try and get that best rate is actually that's just a fool's game. It doesn't actually save you any money in the long run. And number four, you'll often hear about some amazing rate from your friends, family, work colleagues specifically. Lenders come in and out of the market depending on whether or not they need business. And there's a variety of reasons that they do that. They're facing their targets that they need to hit. Sometimes, they'll be offering pricing to particular people or for a certain day just to ensure that they're hitting their loan volume KPIs. And just because your friend has got that rate doesn't mean that you can get it. Like, rates are not as set and standard and offered, especially with the majors. Like with the smaller lenders, typically what you see is what you get. And even lenders like Macquarie, they're a major lender, but what you see is what you get. Once you get onto like CBA, especially Westpac, quite often ANZ, they'll offer stuff to different people depending on different times of the month, and we've actually got to apply for pricing. So I explain that in here, but in case you don't have time, just remember those things. All right, so what do lenders need to do for business? So you've got to understand that lending it's largely homogenized. Lenders don't really have a huge number of levers that they can actually pull to try and get new business in. So some of the ways that they do this, or that they will try and get new business in, is to develop new credit policy. So credit policy might mean, and they will especially announce these credit policies to brokers because we're the only ones that pay attention to lender credit policy. Obviously, it affects our business. They might say, well, for someone who is self-employed, well, instead of needing 2 years of self-employed income, we're going to start to specialize in self-employed individuals, and we only need 1 year of self-employed. A couple of lenders might look to specialize in medical, for example, and they might say, well, we specialize in medical. We're going to allow you to borrow up to 95% of the loan, of the value of the property. Maybe you don't even need 1 year of financials. If you're a self-employed doctor, we'll operate on just like 6 months, like basically 2 BASs. Some lenders even less than that, depending on which lender you go to. Some lenders might try and specialize in really just like safe lending. They just want lenders, they want loans that are low loan to value ratio, so 80% or below. They're just wanting vanilla stuff. That's what they specialize in. That's what they're looking for. But policy is one of the things that they can do. So they might announce a policy, sometimes tweaks around the edges that really only brokers would understand, but tweaks around the edges to try and get some more business in. So that's one way. The other major way is rates. So obviously rates are the big thing that everyone thinks about, everyone talks about. That's what you see on the news. The RBA meets once a month. Rates are really one of the least important things about your loan, unless your rate is like way out of the market. Really, it is honestly one of the least interesting or least important things. Genuinely, like it's not that important. But rates, features, fees, you'll find most of those are about the same. And as I've said at the beginning, you'll find some lenders will sometimes offer, even to new clients, like if you're with a particular lender, they'll offer new clients to that lender or new customers a better rate than what you can get, and there's a reason for that. But rates, features, fees, like they're mostly the same. Most of them have offset accounts, credit cards, redraws, sometimes under an annual fee, sometimes not. So with rates and fees and features, there's not a huge amount they can do there. Most lenders offer basically the same product. Where they will try and differentiate is, as I said, people are talking about rates all the time. You see it on the news, the monthly RBA updates. They will offer great rates, and quite often, this sort of like ebbs and flows. There's not really much in the way of rebates at lenders for refinances at the moment, but every once in a while there's this like there's like a buy up of business by especially the major lenders, where they try and buy up as much business as they can by offering rebates, by saying if you refinance, then we'll give you $2,000 or $3,000 cash in your bank account. That's, and then other lenders will jump on, and then all of a sudden you've got like 15 lenders all offering rebates, all trying to buy business, and we're almost at the same position back to where we were, where that rebate doesn't mean anything anymore. They're having to revert back to rates to try and get clients in, or maybe policy, but you can't talk to the general public about policy because they're not going to understand it. So rates are like a really, really, really big thing that lenders use to try and get new clients in. Now, understand that. I just want to talk briefly about the RBA. So just in case you don't know, the RBA, the Reserve Bank of Australia, has a board of directors that meets once a month, except for January, in Sydney to determine the cash rate. So they have got like there's a whole office building dedicated to the RBA. The board of directors will meet once a month in their boardroom, and they will be presented with a couple of options that have been put together by all of their minions. Usually there's 2, maybe sometimes 3 cases there. Like, do we hold the interest rates? Do we raise them? Do we raise them by 2, or do we drop them by 1? Usually it's like, do we hold, or do we make a small adjustment either up or down? And there will be a for case, there will be an against case, and they will basically hash that out over the course of a couple of hours, and then announce that later on that day to the general public and the eagerly awaiting media. So we're all, holding our breath on the first Tuesday of every month to see what the RBA is going to do, in brokerland at least. So the cash, and they determine the cash rate. So does the cash rate stay the same, increase, decrease? The cash rate is the rate at which the RBA and banks in Australia lend to each other, and it affects deposits as well. So if the cash rate's set at 2%, then pretty much that'll be the target rate at which lenders will lend money to each other, that the RBA will lend out to those lenders as well. It affects the cash rate, it affects home loans, it affects pretty much anything that borrowing and depositing money into banks. It's going to affect those interest rates. Now, it does this because one of the primary goals of the RBA is to keep inflation between 2 and 3%, and raising interest rates basically sucks money out of the economy. So it's a really good way of, if there's too much money around in the economy, raising interest rates, especially if you think about this for home loans, all of a sudden you've got more money going into your home loan, you've got less money to spend elsewhere. It sucks money out of the economy. And that then theoretically drives, this is all basically based on theory, like economic theory, some of which has been completely blown out of the water in the last 10 years with the global financial crisis and COVID, which is a fascinating topic for another day. But the idea is interest rates get raised, we need to put more money into our home loans, and so therefore there's less money to spend in the economy. Now, the reverse of this is that if you've got a lot of money in your bank, like you're older, you're a retiree, all of a sudden you've got more money because you've got money deposited that's actually earning more interest. And so you can take out more interest and you can spend more. So it's a really blunt instrument. It's not really very good, I think, like one lever that the RBA gets to pull. It's not a very good one, but again, that's a separate discussion. To get back to it, they've got to try and keep the inflation between 2 and 3%. Lenders will then set their interest rates at a level above this that ensures that they are competitive, because obviously, number one, they need to be profitable. They've got shareholders. They need to make sure that their profitability is maintained. So they need to push their interest rates as high as they possibly can, while at the same time ensuring that they've still got a steady inflow of new customers and clients, and ideally that they're actually keeping their existing clients. And there's a whole story about that I'll tell you shortly. So that's the rate for the RBA. That's what the RBA does. It's really important that you sort of understand the very basics, or at least just that, if nothing else. So the rate that you see, so lenders operate differently, and often the rate that you see is not the actual rate that you get. So the four majors are especially notorious at doing this. The four majors especially will offer really crap variable rates, and we will actually need to go to them via they've all got pricing tools that bankers and brokers have access to, and ask for a better interest rate. So this screenshot was taken a couple of months ago, but you can see this was from Westpac's account. They were offering a basic variable at 6.09, 1 to 5 years fixed at 6.49%. Those interest rates are not the actual rates that we end up with, because the rates that we end up with are, especially again for the majors, they are based on a discount off a standard variable rate. So a standard variable rate at any given time, let's say it's 8%, they might offer publicly on their website, and honestly, I don't know why they do this, but they do. They might publicly on their website say, you're going to get a rate of let's say 7%. If we actually go and decide Westpac's the best option for us, if you're talking to us as brokers, before we actually select Westpac or any one of the majors, we will put your application and your lending through one of their pricing tools. So their pricing tools will ask for your name, typically date of birth, and usually phone number. And what they'll do is they'll try and match you in their system to see if you're already an existing client. That actually doesn't make a difference. You being an existing client doesn't really offer ever any better interest rates. So there's no loyalty. There's no loyalty reward you get for staying with lenders, which is something that we get asked quite often. But the interest rates that you see online are, especially with the majors, not as good as the interest rates that we'll actually be able to get you. Again, I don't know why they do this. Once you get to the smaller lenders, what you see, the rates that you see on the website are what you get. So that's then pretty straightforward and easy. But here, the reference rate is actually, so really important that you understand the reference rate for this variable rate. You can see 7.19%. The reference rate here is actually 8.93%. And what you're being offered is a 1.74% discount to get down to that figure there. So again, it's almost like a street side game of 3-cup Monty, where they've got an interest rate under one of the cups, and you're trying to figure out where the best interest rate is. And then inevitably, because they're really good at this, you think, the interest rate is there. And then they lift the cup, and it's actually not. It's not there at all, because the interest rate has disappeared somewhere else. So they've got all these really opaque mechanisms to offer a standard variable rate and then discounts, but that's not what you see on the website. If you talk to us directly, we can get you something better. That variable rate is going to be the best rate that we can offer you over the lifetime of the loan. But what we can actually do is increase the standard variable rate and therefore increase your rate over time without actually really telling you. Or increasing them out of cycle with the RBA. There's all sorts of tricks that lenders will use to increase your interest rate over the first 12 to 18 months. So what actually affects the rates that you get? So as I've said, we as the brokers will price your loan using lender software or our knowledge of what's happening in the market. So coming to us, we as brokers, so all lenders have BDMs, like business development managers, and their job is to talk to brokers about that bank's products. So we might have the Westpac or the Commonwealth Bank BDM come to us and say, hey, we've just introduced these new policies. We've just got these rates on. This is what's happening in the bank. We're updating this and we're doing that. For us, it's great, okay, awesome. Usually we're too busy to actually talk to them. But we talk to them. We get ideas on policy. They just remind us what they're good at, because all lenders will have particular policy niches. But we will often get texts as well from BDM saying, hey, just so you know, under the table, we're actually offering this particular interest rate. So we're offering this discount at the moment for this type of lender or for this type of loan amount. All you need to do is just put it in the pricing tool and then send me an email and I'll get you a bit of a better discount. This sort of stuff happens all the time. And so what it means is, if you've got a broker knows what's going on in the market. They're getting contacted by different BDMs. They're submitting pricing to different lenders. They've got a much better idea of what's going on behind the scenes in the lending market than you do. So, it's really important for you to know that. But what else affects your rate? So loan to value ratio, LVR, which is basically how much are you borrowing compared to the value of the property that you're borrowing against. Keeping in mind, a loan is the only reason that a loan exists, or the only reason that a property is attached to a loan is because obviously they can then sell that property if you're unable to make repayments on your loan. So loan to value ratio determines the level of risk involved to the bank for lending you money. So to make that a bit clearer, if you are lending 95% of the value of a property, they've only got a 5% margin. So if you can't make your repayments and the property values have dropped 5%, potentially they're underwater on your loan. If they need to try and recoup that loan because you're not making your repayments, then they have to sell the property. There's a possibility they won't get money back. That's what lender's mortgage insurance is about. But there's a possibility that it's a higher risk, so typically there's a higher interest rate attached to that. But that also then affects pricing as well. So the lower the LVR, i.e. the less that you're borrowing against the value of the property, the lower the interest rate you're going to get because there's a lower risk. Typically, if you're medical, then there's a different set of rules, but for most people, that's what it is. The loan volume, so how much you're actually borrowing, what else have you got at that particular bank. Time of the month is super important. So you can imagine all lenders have volume targets that they want to grow. So maybe a bank wants to grow, like a bank like CBA, I'm just going to throw a number out there and say they want to grow by $1 billion a year. They want to grow their loan book by $1 billion. Now, that's off the mark, but let's say $1 billion. So that means it's going to be around about $833 million per month in additional lending they need to find. So if they're getting towards the end of the month and they've actually realized, well, crap, we need to hit $833 million in order for us to hit our yearly growth target. Like that's our monthly growth target. We're only at maybe we're only at $300 million. We've got to find another $500 million in lending. What they'll do is they'll contact the brokers, just like I said before, and they'll say, hey, like we're actually going to drop our rates. They can't put advertising out everywhere because that takes time to filter through to the market. But what they can do is go to brokers straight away and say, hey, if you've got clients who are looking to refinance literally right now, we can do this rate if you submit in the next week. And that's literally what they do. So they'll pull one of the few levers that they've got, which is interest rates, to try and get people over the line really, really quickly so that they can meet their targets for that month. It's important that you know that because we will quite often receive emails or SMSs or reports and messages about people's family or colleagues getting this really great rate at that particular bank. And then when we go to that bank and try and get the same rate, all of a sudden that rate's not available anymore. And that explains why. It's like maybe that interest rate, that additional discount was only on offer for a couple of days because they were trying to hit their targets. They've hit their targets, they've closed that out, and now they can move on. Location can have an impact as well. And that's actually massive. Like it's really important. I'm highlighting that with exclamation marks. Time of month and lenders volume targets, critically important to understand why some of your colleagues or some of your friends may have got a slightly lower interest rate. Location is important, and it's usually not loyalty. Like loyalty makes very, very little difference in the lending world. All right, so also really important, what happens when you settle? In fact, you know what? I'm going to put this in a separate video. I'm going to call this part 1 and part 2 because this is, it's a slightly separate topic, but it's very much related. So if you're watching this, then look for part 2. It'll be somewhere, and watch this as well. Really, really important, especially if you've just settled on your loan.